Hello everyone, welcome and thanks for watching the Market Report. This show is sponsored by XGO and it airs every Tuesday on the Cointelegraph Markets and Research YouTube channel. On today's The Markets Report, sponsored by XGO, we'll be covering the potential triggers to move Bitcoin's price away from $27,000, including the Federal Reserve meeting on May 3rd. Plus, Coinbase flipping the tables against the SEC, petitioning the regulator for security token classification. Lastly, we'll analyze the forces that have been negatively pressuring Ether's price. Don't miss it, and make sure to like and subscribe the new Cointelegraph Markets and Research YouTube channel. Our first news, written by William Suberg, covers the catalyst for Bitcoin's next move. Bitcoin price flatlines near 27,000. What can trigger the next move? Bitcoin faces a new round of potential volatility catalysts over the coming week after Bitcoin price went down by 10%. After a week in which Bitcoin fell by 10%, sentiment is getting a reset and traders are eyeing key support levels close to $25,000. Wait a minute. That's a couple of traders' opinion. That's technical analysis. There's no really fundamental basis to justify another 10% or 8% drop from here to $25,000. We'll discuss that later. At the same time, consensus is far from unanimous over market health. Some believe that the next phase of upside is around the corner. So now we're going to discuss the Federal Reserve, the FOMC meeting, which will decide the interest rates settled for May 3rd and its impact on risk markets and cryptocurrencies. So the article goes by saying, will the Fed call the markets bluff? Why is he saying this? Because there's almost a consensus, like 90% of the investors expect the Federal Reserve to raise interest rates by 25 basis points, so closer to 5% interest rate. It may be all quiet so far when it comes to macroeconomic triggers this week, but that is about to change. Beginning April 27, new data will emerge from the US, which could deliver a burst of volatility for cryptocurrency lackluster risk assets. So there's the US GDP, jobless claims, and the PCE, the personal consumption expenditures. So it's an inflation data that will be released from April 27 and on, right until May 3rd, when the Federal Reserve will have to decide on the interest rate increase. According to the CME Group's FedWatch tool, as of April 25, there's an 87% chance that the Fed raises rates by 0.25 in early May. So why would a 0.25 interest rate increase be detrimental for Bitcoin? Well, a higher cost of capital causes families and business to become more risk averse. Firstly, because the fixed income returns, the investments close to 5%, become more appealing. But more importantly, financing gets more expensive. This holds back the economy, which is exactly what the Federal Reserve wants to curb inflation. The big question is, why should Bitcoin continue to trade somewhat correlated to stocks, considering the US is nearing its debt limit and the economy is displaying signs of weakness and recession? So yes, some of the traders, some of the investors continue to trade Bitcoin as a risk investment, maybe tied to tech stocks, maybe tied to Chinese stocks, or maybe tied to emerging currencies, but they see the investment as a risk opportunity, something that has high potential of returns, but high volatility, which is not far from the truth. If you are expecting a 12, 18 months horizon, not a 5 or 10 year. So if the Fed really raises interest rates on May 3rd, initially it's going to be negative for risk assets, including Bitcoin. So that's why some traders and analysts are calling for a correction down to $25,000. Again, that's not my base scenario. We recently experienced a 10.5% decline from $31,000. And if you analyze a broader time frame, maybe 2 months, 3 months, you're gonna see that Bitcoin has lost its correlation to stock market. It went up by 70%, while the stock market only gained 10 or 15%. So Bitcoin is proving itself as an alternative store of value, so maybe more comparable to gold, which is trading near its all-time high. Now, on to the next topic, covered by Tom Mitchell-Hill. There's the Coinbase action against the regulator SEC. Coinbase files court action to compel SEC's response to rulemaking petition. Coinbase is looking to force the SEC to respond to its petition seeking rules for the crypto industry, a request that has been pending since July. So the regulator is avoiding giving a clear answer on how tokens should be analyzed if they are deemed or not securities. Even Gensler, SEC chairman, has been deposed on the US Congress and was unable to answer simple questions. In the petition, the exchange asked the financial regulator to answer a total of 50 specific questions concerning the regulatory treatment of certain digital assets. These questions are broad in scope and range, including asking the SEC to provide clarification about how it goes about classifying tokens as securities. Well, it seems like the tables have been flipped, as the regulator has been postponing the ruling and harassing exchanges without ever giving some clear direction on what sets the bar for tokens to become securities. This is not something that should drag on for years to come, as the XRP trial, because in this case, there's no trial, just hearings. Looks like Coinbase is trying to get some of the SEC directors to come out of the shadows, as Gensler has been unable to answer those questions even during a congressional hearing. For instance, Gensler refused to answer whether or not Ethereum could be considered a security. Take note, this case will have a bigger impact than in managed, because judges will take note from the SEC arguments. If there's not a direct relationship between securities and tokens, there's a good chance the SEC will no longer be designated to rule over cryptocurrencies. That's my own opinion and does not necessarily reflect Cointelegraph views. But this case is not going to last for longer than 6 months, and if Coinbase at least partially succeeds, it will bring the SEC away from the sector, because I don't think that most tokens can be deemed as securities considering the current regulation, especially if you're talking to secondary market trades. Coinbase is merely listing tokens that have been issued abroad. They had not participated in the initial sales. So it's a trade between two clients. Coinbase is merely acting as an intermediary. So it's very hard to say that Coinbase is participating on some scheme that is looking to enrich the clients or making sure that the token price will go up. Coinbase does theoretically don't have a say in that. The last news of this week's show refers to Ether negative price momentum, written by our very own analyst, Marcel Pechman. Ether price struggles to maintain support as regulatory challenges and network issues wait. Ether options volume hints at bearish sentiment as the 1,850 support falters. Firstly, the regulatory environment seems to have gotten stricter for centralized exchange. Dubai-based Bybit, for instance, announced that all users must complete KYC identity verification by May 8. US-based crypto exchange Gemini announced on April 21st the upcoming launch of a derivatives platform outside the country. The list of clients excludes US, Canada, and most European countries except Switzerland. So the regulatory environment for centralized exchanges has been getting a lot stricter. Ethereum network is navigating in troubled waters. Given its lower use in decentralized applications, the Ethereum network is probably experiencing its own problems. For starters, total deposits on Ethereum smart contracts, the TVL, in Ether terms, plunged to their lowest levels in August 2020. The culprit, in my opinion, Ether's transaction or network fee, which has been above $4 since February. Here's the chart from DeFi Llama of the total TVL, the total value locked on Ethereum network smart contracts in ETH terms, so in Ether terms. It dropped to 15.3 million, which is the lowest level since 2020. So that's a bearish indicator. According to the DeFi Llama data, Ethereum dApps reached 15.3 million ETH in total value locked on April 24. That compares to 22 million ETH 6 months prior, a 30% decline. Okay, one might argue that the TVL went down, but volumes could have held up. Well, it could be true, except data shows that's not the case. Ethereum's market share by volume on decentralized exchange, DEX, peaked at 75% in the week ending March 5, but steadily declined to 44% in the week ending April 16. This blue area is Ethereum, the market leader currently, with 44% market share on DEX volumes, followed by Arbitrum, the yellow line. And you can see that it peaked at 75% and has been declining ever since. So Ethereum is losing market share on DEX volumes. Gainers on DEX trading volumes were Arbitrum, increasing to 22%, and BNB Smart Chain, growing to 16.6%. One might argue that the success of the Ethereum network's scaling solution necessarily reflects bullishness for Ether's price, but that relationship is not so direct. So we're talking about Arbitrum here. Yes, it's a layer 2 scaling solution, but it drives trades away and TVL away from the mainnet. Lastly, we'll focus on the Ether's derivatives markets, more specifically, the put to call options volume. The put option gives the buyer protection for downside price movements, so it is more frequently demanded when the market is leaning bearish. That's the chart right here. So numbers below 1, which is this line, reflect bearish, as there's more demand for protective put options. And the recent data from April 25 shows the indicator at the lowest level in more than 3 months, indicating excess demand for neutral to bearish puts. Currently, the protective put options outnumber the neutral to bullish call options by more than 4 times. So the bottom line here is, I don't think Bitcoin has anything supporting further downside to $25,000, except from the macroeconomic scenario, which could be detrimental for the short term, but it's positive for the medium to long term, as the US debt is reaching its limit. So the Congress and Senate will have to further raise those limits, and indicates that the government will continue to add money on the market, so print new money, so to stimulate the economies, which is good for Bitcoin. On the other hand, Ethereum looks prime to retest $1,700, maybe down 5, 10, 15% over the next couple of weeks because of the reasons we've shown. The Ethereum transaction fee above $4 is causing shift to competing networks and second layer scaling solutions. So it's driving down the TVL. It's driving down Ethereum DEX volume. I wouldn't panic. I don't say that there's too many red flags on Ethereum, but the put to call ratio tells us that professional investors are fearing of a potential price correction more substantial than 10% in Ethereum. Well, that's it for today. Don't forget to visit Markets Pro, the professional Cointelegraph alerts platform. Our proprietary indicators have been giving profitable alerts for months. There's a 20% discount link in the video's description. See you!